This week's term on Kevin Explains Crypto is futures, and then in parentheses I have Bitcoin futures. Well, Bitcoin futures. So my first thing, what is a future, right? So when you talk about just the generic term of futures, you can kind of glean a little bit what it is just by the word future. You are basically buying or selling something based on a possible future price. So you're betting on a future price. Most futures contracts outside of Bitcoin, and not all of them, but most of them, are not perpetual. In Bitcoin, in crypto, most futures contracts are perpetual. That means there's no end date. You simply are you're seeing a live price, and you're either buying or selling at that price, and you're predicting that in the future, obviously, if you're buying, the price will go higher, and if you're selling, the price is going to go lower. The difference, however, is that most futures in the real world have an end date. They're either monthly, quarterly, mostly are monthly or quarterly. Some do go for further, and some are arbitrary dates, but most are monthly or quarterly. That means that contract will automatically end. If you don't liquidate it, if you don't get out of that contract, if you don't sell and take your profits, for example, or buy and take your profits and leave that contract open, it'll automatically close on that maturity date. Now, why would someone choose that type of future versus a perpetual future? Well, most futures, at least not most, many futures in the real world are used for hedging. For instance, you're a multinational corporation like Walmart, for example, or whatever, Tesco, and you sell products all over the world and you're paid in multiple currencies. You know that you're due 400 million euros from Europe and you're a USD-based business, and that payment's going to come within 60 days. You may want to hedge your exposure to that euro contract in case euros are valued at more, at let's say less US dollars than they are currently. Then basically you want to make sure you're going to get paid at least the same amount of US dollars that you're currently owed in terms of the conversion rate as of today, right? So you open a futures contract to hedge that exposure. Now, again, Bitcoin futures, most are perpetual. So it's a bit different. They're not really futures, but they're future-like. And why trade futures rather than the underlying product? Mainly for liquidity. Futures can be extremely more liquid than the underlying market in an illiquid market, because it really depends on how much the market maker is willing to take. How much BitMEX can take on exposure is basically how much liquidity there tends to be. And because most futures providers are actually taking the risk themselves, if most clients are losing money, they will take substantial amounts of risk, which means there's substantial amounts of liquidity. One more thing to mention on Bitcoin futures, and I think Harold mentioned this in the chat one time, is that most of these are inverse, actually. And I haven't really paid attention to this, to be quite honest, but with most futures contracts, you are basically paid in whatever the quote currency is. Is that right? Bit of quote currency? I think so, yeah. So if you had in the normal world, if you're having a future on a specific commodity, you're going to be actually paid in the underlying quote currency, which might be USD or Euro or whatever the case may be. It depends on where you're actually buying or selling that contract. However, in an inverse, you're actually paid with the other side. So if it's a Bitcoin future contract, even if it's priced in USD, you'll be paid in Bitcoin. Yeah, I think that's it.